a voice on the global arena. Jason Dow, he's the head of emerging market strategy at Societe Generale, joins us right now on the show. Jason, good having you. Thanks so much for joining in. I think the biggest question in the minds of almost every investor seems to be that in light of what's happening between US and China, what does the rest of the emerging market pack do? Does that risk-off envelope them as well, or would some of them fundamentally emerge stronger and therefore might see investor interest? What's your thesis?
Yeah, no, it's a very good question, and it's something that we're debating very actively internally and with investors. I think, very simplistically, the tariffs that have been imposed, if they continue going forward, or if there's further escalation, is negative for global growth. We know it's negative for China, we know it's negative for the US, and these are the worries that are starting to surface in the market. From the very short term, I would say, if you're looking at the next 6 months, the next 1 year, even slightly beyond that, I don't think that there's anybody that's really a true beneficiary to some of the problems that we're seeing with global trade. As we move further into the future, there is going to be the possibility that multinational companies are going to look elsewhere other than China to set up their manufacturing activities. But that's a very long-term process, and it's not something that really benefits any emerging market in the very initial instance.
Jason, what do you put out in terms of your advice when people ask you about how to approach investing in the current scenario? Because I think EMs are chalk and cheese. Some are trading near recent highs, some are not. China is certainly not. It's in the epicenter of the trade war. And the ones which are trading in or around new highs have valuations which, in a lot of people's thoughts, are prohibitively expensive.
I do agree. There has been quite a bit of dispersion in the EM currency market over the recent past. So you see countries like North Asia, for instance, Korea near its weakest level, China near its weakest level, as you mentioned, where there's some other currencies, let's say such like India or Indonesia, which have held in much better at this point. And I think that is a reflection of the countries that are the most hurt at the very, very beginning are countries that are very export-oriented, very linked into the Chinese supply chain, and also very linked into tech. So those countries have been the first mover. Countries like India, Indonesia, their export structure is different. The importance of exports to the overall economy there is somewhat smaller than the North Asian countries. So there has been this type of dispersion. But I'm a firm believer that over months and quarters, if we are going into a US recession like the market is starting to consider at this point, and growth momentum is going to be lower and people are going to be worried about the tail risks, I don't think that anybody in the emerging market currency space emerges as a winner in that scenario. So there are some countries that are stronger at this point, but they could probably play catch up over the next year.
Jason, after the non-farm payroll data came in from US on Friday, which was way below what the street was expecting. In fact, the number came in below 100,000 mark as well. And now, in light of that data, the chances of rate cut by Fed have only gone higher in the month of June. So let's say if the rate cut comes about, how do you see the fund flow shaping up? And you were talking about the currency market. How do you see that impacting the emerging market currencies?
Yeah, a quick policy response by the Fed is going to be helpful as far as stabilizing sentiment. But I do think the one thing that we have to keep in mind at this point, the aggressiveness of what the market is priced for the Fed usually means that a recession is actually very close. So it's maybe not that they would be taking preemptive action. So as the Fed starts to ease, if they do it in a very short period of time, like the market's starting to gravitate towards, it can help stabilize a little bit. But I still think when you're trying to trade off what's happening on the rate side in the US, it's okay for fixed income in emerging markets, at least in the initial instance. But I don't think that it's actually going to be positive for the currency market.
In light of...
I think at best you have a situation where...
Please go ahead, Jason, complete your point.
No, I was going to say, in the best case scenario, EM currencies are stable rather than appreciating, because I do think, in addition to the impact from negative growth, there's, two other factors I think that are, weighing on the ability of EM FX as an asset class to do well over the medium term. And other than growth, it's also on the positioning side, maybe not so much in a currency like India on fixed income, but in the vast majority of EM, there's been a very substantial amount of bond inflows that have come into these countries over the past 10 years, and investors are generally overweight their benchmarks. The third point is that when you look at emerging markets as a group, the spread that investors are getting relative to US Treasuries, or the yield pickup in emerging markets, is actually relatively small over the past 10 years. So the attractiveness of EM from a yield pickup standpoint is also not, is not working in emerging markets' favor.
The one factor that will aid all of sentiment, even if there was a bit of a global pull off, is crude coming off. Now, this morning we had somebody from Morgan Stanley saying that instead of looking purely at crude and its impact, or looking at crude in isolation, look at crude and other commodities, and if all of them were to cool off, then it probably helps an importing nation like India. How closely do you look at India? How do you closely look at Indian macros and Indian equity markets, if you do? And what are your thoughts thereof?
I think, the oil question and how that relates to emerging markets, I think is very, very interesting, because, what we saw prior to, let's say 1-2 years ago, was that typically when you had oil prices increase a lot, that was good for EM. It was even good for EM currencies that were importers of oil. When oil prices fell, it was generally negative for emerging markets, even when the country was an importer of oil. So prior to 2 years ago, the picture for oil, it seemed to be that the signals we were getting from price were much more demand-driven type of signals. So if oil's going up because of demand or going down because of demand, and that's a reflection of what's happening in the global economy, that is what tended to move currencies over that period. Over the past year or so, it seems like maybe supply has been a greater issue. And if oil is coming off because of supply rather than demand, then that can be beneficial for a country like India that has high oil importing needs.